One of the most common ways to build a business in the option space is to create a short volatility portfolio. What this means is that we look through the market and find areas where the option premiums are expensive, and then we sell them. Not just on one stock though, but we actually go and build a basket or a whole portfolio of these positions, each of them traded in small size. The reason this is important is because in general, the market is very efficient. So when we do find a good trade, the odds are that our edge is actually quite small. Now we don't need a big edge to make lots of money, but what we do need is to spread our risk across a lot of trades so that our expected value can be realized. Any trade can be a winner or a loser, and it takes many trades for a small edge to really show itself. So in this video, we are going to go over how to use the Volatility Insights dashboard to find and place profitable option selling trades so we can build a portfolio like this for ourselves. So when it comes to finding expensive options, there are really three overarching steps that we need to take to place these trades. Step one is to find trades that look like they may have a pricing inefficiency. Step two is to understand why the inefficiency exists and confirm that a risk premium does in fact exist. And then step three is to place a trade that capitalizes on this inefficiency. It's really that simple at a high level, and logically, it makes sense. Find a data inefficiency, apply some logic to it so it's not just numbers, and then place the correct trade. Let's go over this process using a trade example, and at the end, we can talk about how to manage these positions and our newly constructed short vol portfolios. So step one is to find options that look like they may have this pricing inefficiency. Since this is such a common search done by Predicting Alpha members, we actually built a function specifically for it. Our search starts at our volatility scanner here, and what we are going to do is click this drop down for filters and select expensive option premiums. What this will do is filter the entire US options market and present us with liquid stocks that have a higher 30-day implied volatility than our forecast of volatility, which is a statistical model we provide that estimates how much a stock will move in the future. Finally, it will sort this list by the ones that have the biggest difference between implied volatility and our forecast. This will be our base watch list that we will use because they all have a signal that basically says, hey, options look pricey here, dig deeper into these stocks. Now from here, we need to move into step two. And step two actually has a checklist that we need to go through to help us narrow down our watch list to the trades that we actually should take. And here is the watch list. Number one, how high is the implied volatility versus the realized? Is there any recent news that would cause volatility to spike? What is the one-day move versus implied one-day move? Meaning, what is the market saying the stock should move today versus how much is it actually moving today? Then we look at whether or not the price of the actual underlying is flattening, or are we still seeing the price trend in one direction or another? And then finally, we look at the volatility relative to pricing from the past, right? The IV versus where that number has been historically. What we do is go through this checklist one by one, and at the end of it, we will know if we have a good trade or not. So let's use an actual example here to go through this. The stock that we're going to take a look at is actually on the first page of our scan right here. We're going to take a look at UNG. So for this stock, the first thing we're going to do is take a look at the volatility time series. What I want to see here is either a consistent spread between the implied and realized volatility, or a spread that has recently opened up. I also like to see that the realized volatility line is on a downtrend, because this means that volatility we have seen in the last few days is declining. And as we can see here, there's been a consistent spread between the 1 month implied and realized volatilities. And that in the last couple days, the realized volatility and the implied volatility have both come down a few points, signaling that the market is starting to say there will be less volatility moving forward. This is a good signal for us. Once I see this, I go to the next item on the list and pull up news for the stock on Google. Is there anything that's happening that would cause the volatility to spike? So I might come over here and type in UNG stock news, right? And this is a natural gas fund. We can look at some of the news here, maybe go over to the actual news tab for Google. And basically, this is an industry-wide thing that we're seeing for natural gas, right? With everything happening on a geopolitical level, rising gas prices, it makes sense that we're seeing a lot of volatility in this sector. And therefore, it also makes sense that we're seeing the market imply more and more volatility as time goes on. So it looks like we can explain why we're seeing this spread between implied and realized volatility. So the next thing I'm going to do is move on and take a look at the key metrics box, which is just to the right of the volatility scanner. What I really want to look at here is the implied move one day versus the price change today. I want to see stocks that are actually moving less right now than what the market is implying they should be moving right now. And the reason for this is it means if we were in this position already, we would be making some money right now. And as we can see, the implied move for the one day is 6.25%, and the price change is minus 5.2%. Now, while that is a very big move in the underlying, 5% a day move is very big, we can see that the market is actually implying an even bigger move. And using techniques such as delta hedging, which is covered in the silver level education, we're able to still monetize this strategy, even if the price continues to trend to the downside. Now, whether or not the stock will continue to trend is definitely an important question, given the way that a straddle works, which is the tool we're going to use. So what I like to look at next is this price graph here. And what I really want to see here is just that the price is starting to stabilize. The ideal situation is that the price is very steady, or even if it's choppy, chopping back and forth around a certain price range. All of that works great for me. And remember, if we do see a trend, that's also okay. We just need to keep in mind that delta hedging will be something we'll need to utilize. And as we can see for UNG, we did have this period from August to October where we saw the price come down drastically. But ever since the last month, it's really chopped around this $20 mark, which is a great thing. Because if you think about it, a 6.25% a day implied move, that's pretty steep. That's a really big move. And we've seen this chop within a 5% range for the last month. The last item on our checklist is to compare the current level of implied volatility to where it's been in the past. And for this, we are going to use the volatility cone, which is right here. What this shows us is the current level of implied volatility, which is the green line, and it compares it to the highest, lowest, and average that we've seen the volatility at for that expiration over the last year. Looking at the red and pink line, we can also see the Q1 and Q3 lines, which are the 25% and 75% lines. So for example, if we were just to isolate those lines here, 25% of the time, implied volatility for each expiration is below this red line. 25% of the time, it's above this purple line. And 50% of the time, it's in between here and there. Looking at the current price, we can see that we're above the 75% line, getting pretty close to the highest we see implied volatility get. Now, given what we're seeing there, this is also another good signal that this is a stock we should be selling options on. So at this point, our analysis is complete, and we can summarize our thesis in a couple sentences. We believe that options on UNG are expensive because the implied volatility is higher than our forecast, and there is a persistent gap between implied and realized volatility. Looking at the news, we can see that something happened which is driving this premium in the options, namely the geopolitical risks around the natural gas industry. The move in the stock today is less than what the market is implying it should be, so it looks like things are calming down a bit. The stock price has been staying in the same range over the last month, so we likely won't have too many issues delta hedging the position. And lastly, the current level of implied volatility is higher than both the median or the average and the 75% line that we see for this stock. And since we know volatility mean reverts, a concept taught in the bronze level education, we think that it should come down from this level eventually. Sounds like a pretty solid thesis, right? And really, it didn't take that much work. Now that we have our trade, we actually need to place it. So to do this, let's go over to Thinkorswim and see what this would look like. The option structure that is optimal for this strategy is the straddle. Selling straddles using at-the-money strikes is the cleanest way for us to sell the implied volatility and make money if realized volatility is less. So let's go ahead and pull up one of these straddles. Now, I'm thinking we're going to do the December 16th options here. It's a monthly, expires in 16 days. So let's go ahead. Stock's trading at about $21. let's sell the 21 straddle. So I pulled it up here, analyze the trade, and this is what it looks like. Let's move down to one lot. Here we go. This blue line is what our trade will look like at expiration. So you can see that as long as it stays between 24.50 and 17.50, we should make money on this trade by 16 days from now. And that's actually a very big range if you think about it. The implied volatility is very high. We're basically looking at needing to see 15 to 17% moves up or down in order for us to hit our break evens, which is a very large range for us to work with. And if we do see the stock start to trend, but with less realized volatility than implied, we can simply hedge our deltas, which you can learn about in the Silver Education. Now, if you want to do a risk-defined version of this trade, you can do an iron fly or an iron condor instead. But by doing this, remember that we are giving up some of our edge. So my first recommendation is just to trade less straddles, so that if we do see a large move, the damage is controlled without having to give up our edge. So when do we close this trade? Well, there are a couple scenarios. For taking profit, we either close when the gap between implied volatility and our forecast of volatility closes. Or if the trade is going very well, we can continue to hold and just close before expiration. Do not hold them through expiration. For cutting losses, we will close out the position if the realized volatility is consistently higher than the implied volatility, or if the stock trends too hard in one direction. One day of high realized volatility is okay, but if we start seeing multiple days in a row, we are likely wrong and we should cut the trade short. If we are running the strategy correctly, the losses from that trade should be balanced out by the gains from other trades that we have on, which is why it's important to place many trades of this style, each of them in small size. Remember, our edge is small, and diversification is how we really make that edge show itself. A quick note for you is that if early on in your analysis, you realize that a stock is not a good fit for taking a trade on, just move on to the next one, right? Maybe you pull up a stock and the implied versus realized volatility, there's really no spread there, or the price is just plummeting down to zero. Well, you don't need to continue with your analysis. Just move on to the next trade. I'll usually flick through 2 to 5 stocks before I even find something worth digging into further. For example, I may want to skip biotech stocks. So all I need to do to have a quick check for this is come back up to my scanner, add the sector and industry onto it, and right here at the end, I can see what industry things are in, making sure that I'm avoiding the ones that I'm not personally interested in. Remember, I'm looking for an edge here, and if something isn't apparent to me off the bat, then I'll find something that's really jumping out to me. And that is how you run this strategy. If you want to learn more about it, you can go through the Bronze Education, and then there's actually a very advanced version of this strategy, which I call the Fund Manager Method. It's pretty much the ultimate way to price options, but it requires a lot of knowledge to execute properly. So if you want to check that one out to see where you can work towards with a strategy like this, you can see it as the first video that's available in the Gold Education. Now you can also meet other traders running this type of strategy in the Discord server by going to the Vol Trade Ideas channel. Share your analysis there, and I'll personally give you feedback along with other members in the community. Happy trading, everyone, and I'll talk to you soon.